If you are around 40 years old, you are probably exhausted from running on a financial treadmill that keeps moving faster no matter how hard you run. What if the real secret to financial freedom is not about sacrificing your happiness today, but about changing where your money flows tomorrow? In this video, we are breaking down a hidden strategy called infinity investing that makes wealth completely inevitable. You will discover the exact 4-bucket system used by the wealthy and a simple percentage rule that plugs your financial leaks forever. The most surprising story of how a high school volleyball coach built a multi-million-dollar sports facility while working completely for free is coming up. But first, let's unlock the foundation. Welcome to Teddy's Wealthcraft, where we help everyday Americans build real, lasting freedom. If you're ready to think smarter about your money, hit that like button and follow the channel. The specific investing strategy we reveal later in this script acts like a financial shield, ensuring you can never sabotage your own retirement, so you will want to listen to every word. Let us have an honest, unfiltered conversation. If you are in your 40s, you have probably spent the last 20 years working hard, paying your bills, and trying to do the right thing. But you might also have this quiet, nagging feeling that you were just running in place. You make decent money, but at the end of every single month, there is almost nothing left to show for it. To understand why this happens, you have to look at how money actually moves. Every single dollar that touches your life falls into one of 4 distinct buckets: income, expenses, assets, and liabilities. Most people only focus on 2 of these buckets. They look at their income, which is their paycheck, and they watch it flow directly into their expenses, like groceries, utility bills, and insurance. If this is all you are doing, you are mathematically guaranteed to spend your entire life running in place. You are trading your precious time for dollars, only to let those dollars slide straight out of your hands. To break this cycle, you must understand the difference between assets and liabilities. An asset is something that puts money into your pocket. A liability is something that takes money out of your pocket. The problem is that the middle class is heavily trained to focus on liabilities instead. We are told to buy a bigger house, get a nicer car, or take out loans to cover our lifestyles. When you let your liabilities control your life, you fall into what is known as the losing loop. In the losing loop, you take out a mortgage, a car loan, or accumulate credit card debt to cover your daily expenses. Then, your monthly income has to go toward paying off those liabilities first, leaving you with even less money to cover your actual living expenses. To make up the difference, you borrow even more money, perhaps taking out a home equity line of credit or swiping a credit card just to stay afloat. This is the exact cycle that leads directly to debt, high stress, and eventually bankruptcy. It is the trap where you wake up at age 40 and realize you are in a dire financial situation, despite working 60 hours a week. The truly wealthy do not live this way, and most people never realize how simple their actual strategy is. The wealthy use a completely different flow. They do not use their hard-earned labor to pay for their lifestyle. Instead, they use their assets to cover their expenses. Imagine having a system where your daily bills, your housing costs, and your grocery runs are paid for by passive streams of income that arrive whether you work or not. When you reach this point, your paycheck from your day job becomes completely optional. The wealthy focus on building 5 specific passive income streams that have nothing to do with a traditional job: rents, royalties, dividends, interest, and capital gains. These are the tools that generate cash day and night. To get your financial life into this position, you need a clear, disciplined set of rules to manage your cash flow. This is where the 70-30 rule comes in. Under this rule, you commit to living off exactly 70% of your take-home pay. For example, if your family's monthly expenses are $7,000, you need to have a take-home income of $10,000. Now, if you are looking at your current budget and thinking, Toby, there is no way I can live on 70% of my income. My bills are already too high. You have 2 choices. You can either radically cut your lifestyle, which is painful and exhausting, or you can focus on increasing your income. There is absolutely no shortage of ways to make extra money today. You can start a side gig, launch a small side hustle, or get involved in micro real estate investments like wholesaling or flipping older mobile homes after hours. By focusing on growing your income stream, rather than just cutting back on your quality of life, you can easily drive your expenses down to that safe 70% threshold. So, what do you do with the remaining 30% of your income? You divide it into 3 equal 10% slices. We are about to reveal the exact daily habit that made a simple cashier over $25,000. But first, you must understand how to allocate your extra 30%. The first slice, 10% for giving. The first 10% of your income goes directly to giving. Now, this might sound unusual or counterintuitive if you're currently struggling financially. You might say, Toby, I don't have the money to give 10% away. But over 30 years of working as a tax attorney and analyzing the tax returns of thousands of highly successful, self-made investors, one pattern stands out. The people who do well consistently are voracious givers. Giving changes your psychological relationship with money. It shifts your mindset from a state of scarcity and fear to a state of abundance and confidence. And if your budget is truly so tight right now that you cannot spare a single dollar, then give your time instead. Volunteer for an organization you care about, share your skills, or help someone in your community. When you give value freely, it has a magnetic way of returning to you from directions you never expected. The second slice, 10% for debt payoff. The next 10% of your income is directed toward liabilities. This is not the money you use to make your standard monthly payments. This is an extra 10% used to pay down the actual principal of your debts. When you make standard payments, the bank structures the loan so most of your money goes toward their interest profits. By targeting the principal directly, you accelerate the payoff timeline, collapse the total interest you owe, and systematically destroy your liabilities until they are completely gone. The third slice, 10% for building assets. This is your seed money. It is the capital you will use to build perpetual, lifelong streams of income that can eventually be passed down to your children and grandchildren. And here is where the real magic happens. As you consistently apply this 10% debt payoff strategy, your liabilities will eventually be wiped out. Once your debt is fully paid off, that 10% slice is no longer needed for liabilities. You can immediately move that entire 10% over to your asset bucket. Now, you are investing 20% of your income into assets every single month. Over time, as your financial confidence grows, you can easily scale this up until 30% or more of your monthly income is flowing directly into wealth-producing vehicles. The final insight we are building toward changes everything about how you protect what you build from your own mistakes. Once your money reaches the asset bucket, you need a clear plan so you know exactly where every single dollar should go. This is the 30-30-30-10 investing strategy. Under this system, you divide your asset pool into 4 structured buckets to balance high cash flow, long-term growth, and ultimate safety. Bucket 1, income-producing stocks, 30%. 30% of your asset pool goes into income-producing stocks. We do not speculate on volatile growth stocks or chase hypes. We look for mature companies that pay reliable dividends. To supercharge this bucket, you can use a professional cash flow system called the wheel strategy. Under this approach, you write cash-secured puts to collect premium income just for agreeing to buy a stock you want anyway. Once you own the shares, you collect regular dividend payments. Then you write covered calls against those shares to collect extra premium income. When the stock eventually gets called away, you collect your capital gains. This simple system allows you to make income 4 different ways from a single investment. Bucket 2, real estate or real estate equivalents, 30%. The next 30% goes into real estate. If you are a beginner or starting with a modest amount of money, the easiest way to enter this space is through real estate investment trusts, or REITs. REITs trade on the open market, exactly like a stock, meaning you can buy them instantly through a standard brokerage account and gain immediate exposure to commercial and residential real estate. Once your total wealth grows past $150,000, you can transition this 30% bucket into physical real estate, like single-family rental homes or duplexes that pay you monthly rent.
Bucket 3, managed portfolios, 30%, goes into managed money. This means you are either hiring a vetted professional to manage your funds, or you are directly mirroring a recommended high-quality dividend portfolio built by seasoned experts. The main goal of this bucket is to protect you from yourself. When the market gets volatile and emotions run high, having a portion of your wealth handled systematically by professional rules keeps you from making impulsive mistakes that destroy decades of compounding progress.
Bucket 4, cash or cash equivalents, 10%. The final 10% of your asset pool is kept in cash or liquid equivalents. This includes money markets, high-yield savings accounts, gold, silver, Bitcoin, or liquid US dollars. This is your ultimate safety net and opportunity fund, giving you quick, hassle-free access to capital in case of a personal emergency or a sudden, massive discount event in the stock market. When you set this system in motion, something incredible begins to happen. Your assets start producing cash. If you were living off 70% of your income, and your stock dividends, REITs, and rental properties start kicking off $1,000 or $2,000 a month in extra cash, you are suddenly no longer living off 70%. Your real expense burden drops to 60%, 50%, and eventually 40% of your active labor income. This creates a self-sustaining compounding cycle called the infinity loop. The cash your assets produce is channeled directly back into buying more assets, which then produce even more cash, which buys even more assets. Eventually, the passive income generated by your assets completely covers your entire living expenses. When you reach this milestone, you have hit infinity. You are officially completely free. What does life actually look like on the other side of infinity?
It does not mean you stop working or sit on a couch all day.
In fact, most people who reach infinity find themselves working even harder. But they are working out of pure purpose, joy, and fulfillment, rather than survival. Take the story of Aaron Adams, a regular investor who followed this system. Once his assets reached infinity, he decided to dedicate his life to coaching high school volleyball. He used his real estate wealth and his own nonprofit organization to build a state-of-the-art sports facility where local club teams can play, and he now competes for the state championship every single year. He does not do it for a paycheck. He does it because he loves it, because it is fulfilling, and because his assets have bought back his time. That is what this strategy is truly about. Buying back your freedom so you can build the life you and your family deserve. If you could convert just one minor daily luxury into an automatic compounding investment this week, what would it be? Let me know in the comments below. If this brought you value, drop a like and follow Teddy's Wealthcraft to think smarter, protect your family, and see the financial opportunities that others miss. If you want to make sure your compounding engine never fails, click on the video on your screen right now to discover the one monthly habit you must start doing today.